Good morning, ladies and gentlemen, and welcome to the KINOVO PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all of the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand you over to CEO David Bullen. Good morning, sir.
Good morning, Jake, and good morning, everybody. Thank you very much for your interest in participating in our presentation today for KINOVO's half-year results. With regards to the presentation, just a broad agenda for you all. First of all, we'll cover, for those who aren't quite aware of KINOVO, a very brief introduction into the organisation. Alongside that, we will cover the financial operational highlights. To my left is Clive Lovett, Group FD. To my right is Lee Venables, COO. Clive will cover the financial summary. We'll go into some of the legislation drivers and some of the government's decarbonisation objectives that are providing tailwinds for the organisation, along with the funding opportunities that will be required to support those. I'll give you a breakdown in terms of the segmental analysis of the business in terms of our split as well as our growth themes. Cover off a little bit in terms of our social value, which is very important to us as an organisation, and then summarise that in terms of our outlook. So in terms of introduction to KINOVO, our vision is that we work together to lead in the provision of safe and sustainable property solutions and services that not only protects our customers, but benefits the environment and enhances the communities and the lives of our employees. We're focused on three service divisions: mechanical, electrical, and building services, and alongside that have three key strategic pillars that we focus on. One is regulation, another is regeneration, and the final one is renewables. As an organisation, we've gone through a significant period of change over the last 18 months, 2 years, and with that have three subsidiaries now, having disposed of, first of all, P&R, and then alongside that, DCB. It has not been without challenges, which we acknowledge. However, the streamlining of the organisation and the focus on our three service divisions and our three strategic pillars leave us well set to capture on the opportunities ahead of us within the market and the sector itself. Geographically, we're very focused, fundamentally within the London and South East area. We have, through opportunities in terms of previous contacts, expanded a little bit into the area of Birmingham, but remain very much focused in terms of London and the South East. The business is founded on regulation, which from an ESG perspective and sustainability piece, we are well ensconced with. As the wheel on the presentation will outline, regulation fits in with governance. On the right-hand side, you could just see a small flavour of the certification and accreditations that we hold. That regulation piece is non-discretionary, compliance-driven, regulatory-driven, and with that then feeds into our regeneration theme, which sits along that social perspective, not only externally as well as internally, but alongside that regeneration piece are renewables, which, as we are all aware of in terms of the government's net zero strategy, leave us well placed within our three pillars and our three service divisions to capture in terms of the opportunities moving ahead. If we move forward into our operational highlights with respect to our service divisions and our three key strategic pillars, the revenues are quite diversified across these complementary divisions, with mechanical accounting for 25% of our revenues, electrical at 40%, and building services at 35%. In terms of growth, mechanical in the first half of the year has grown 6%. Electrical has grown 37%, and building services has grown 30%. Within that is the three pillars, all of which have also demonstrated growth. Within regulation, regulation is up 14%, regeneration is up 67%, and the renewables pillar is up 20%. Specifically on the electrical services division, this has been driven by new legislation, and we'll cover that off in a little more detail further in the presentation, with the regulation pillar up 2.3 million at 48%, and the renewables pillar up off a smaller base, but at 44%. Similarly, from building services, we're capitalizing on a fabric-first approach to decarbonisation, as well as new contracts, and that's contributed to the regeneration pillar also growing up at 2.3 million, 189%, and a new entrant in terms of the renewables pillar of 500,000. The segregation for us, specifically between renewables and regeneration on building services, is that the renewables pillar is driven by specific decarbonisation projects. There will be an overlap from regeneration, but specifically in the renewables pillar is solely decarbonisation projects that we undertake. Our 3-year visible revenues over the period have grown to 146 million, and we have a robust pipeline in play with a number of bids and tenders still waiting responses. Within that, 97% of our revenues are recurring, and this underpins the value of our long-term contracts and that visible revenue status that provides that certainty of outlook in terms of the business moving forward. Sustainability and ESG, as we said, we are in the heart of that in terms of what we do, as well as how we do it. We've published ESGM strategic report, and a carbon net zero strategic report is currently being prepared. Regarding an employee survey, we have recently completed one with significant engagement of 69% of employees responding. This is up significantly from the 30% that initially responded to our first employee survey, with an overwhelming recognition that the organization is building a culture and an environment that employees want to be a part of and are proud to be a part of. Within that, we're all aware of the labor challenges within the market. And besides setting a remuneration package that is attractive to both our current employees as well as potential employees, we're very much focused on increasing our apprenticeships within the business. Last year, they sat for circa 10% of our employee base, and at the end of September, accounted for 13% of our employees. And to date, in fact, that has increased again to 14%. With respect to our fleet, we have circa 112 vehicles on the road, and we have undertaken a survey to assess and facilitate the transition of our fleet to electric. This will prove a challenge moving forward due to a lot of our engineers and operatives having on-road parking, and therefore the survey is there to assess ways that we can address this without reducing the productivity and efficiency of our team in the field. We've invested within the period in a greener solutions manager to further strengthen our commitment to decarbonisation and drive some further focus within the business. And alongside that, we have recently completed a customer insight perception survey, which we'll allude to a little bit further, which will allow us to prioritise further growth opportunities moving forward. I'll pass over to Clive to cover the financial highlights.
Good morning, everyone. Really just I've got a number of slides to come covering income statement, cash flow and net debt. Highlights are there. We're seeing good growth across all areas of the business, good position on net debt and robust cash flow. Before I go into some of the other slides, I just wanted to really cover out the discontinued operations, which is relating to DCB, as David alluded to earlier on. We have a responsibility and a liability to complete some construction projects that were outstanding following the disposal of DCB, and it subsequently went into administration. So we have a continuing responsibility relating to that. We've estimated that total cost is around about 4.3 million. That 4.3 million is from a robust review and detailed review. We've engaged a third-party QS consultancy firm who have gone into significant detail, including an inflationary impact included into that number. What we've also done is we've been in sustained negotiations and discussions with clients, which continue as well at this time, and includes that together with an internal team that we've recruited to effectively to manage that business. We've also been in negotiations with the clients to help to mitigate the impact on that. So that we're expecting to be around about 4.3 million. We have provided that full liability at the half year numbers. So you'll see that we've fully provided for that. That will be the full impact of the P&L impact now over the years, subject to that 4.3 million coming in. Cash flow will be over the period of the contract, of the various contracts, which we expect the only one to be outstanding at the back end of next year. Has a larger sort of runway to completion. The rest of them we will expect to have been completed. At the moment, we have 2 of those projects are on site, and we have 3 that we're expecting to start in early new year, and are in productive discussions with the rest of the clients to get the remainder of those contracts moving. So we have a detailed knowledge, understanding, and feel that we're in good control now on those projects to deliver them to completion. If I just cover out some of the other slides. So just on the financial summary for the income statement, I think what we can see is across the whole of the income statement, we're seeing positive results from top level revenue up 25%. Gross margin is up 1.2% to 25.9%. And that delivers down into a bottom line EBITDA thereof 31% up. We use this adjusted EBITDA position, which is after lease payments have been accounted for, really just for consistency with our internal reporting. That leads to bottom line numbers that are actually higher percentage up. So you'll see down at the bottom, profit before tax and EPS around about up sort of around about 60% at that position. And that's really because we're seeing our non-underlying numbers that we report separately in the income statement are declining and reducing quite significantly now. The significant and most significant element of that non-underlying is the amortization, which is non-cash amortization of our customer relationship intangible asset balance. And that actually at the half year is actually fully amortized. So there'll be no further costs coming through on that. And we're seeing that that's already coming through in the half year and leading to that 60% uplift in the projects, in the profit and EPS. I think that what we're seeing, and David alluded to before, we're seeing growth in all areas of the business. We're seeing growth in the service segments and also, as David alluded to earlier as well, in the pillars. And that's leading to the bottom line. And I think the only other element to report there is that we don't have any tax payments, corporation tax payments in the current financial year because of some of the tax losses that we have brought forward. In terms of cash, we've seen some fairly robust cash generation. This is just really a very simple reconciliation just to demonstrate where the cash has come from. The only thing of real significance there is to mention is just there's an adjustment for HMRC payments. We did at the year end have some deferred HMRC payments which have been fully repaid in the period, and we're now into a fully normalized payment alignment with HMRC as was agreed. That's gone through, and so we've added that back to give an underlying cash flow. And you can see there we've cash converted against an adjusted EBITDA of 130%. Really just to mention that that's probably is higher than we would otherwise normally expect. I think our normal expectation would be in the region of a 90% cash conversion. We have achieved greater than that over the last periods, but I think on an ongoing basis, that would be a more normalized. We've achieved that higher level at the half year, principally because we actually have a purchasing card arrangement with HSBC, which we extended the terms on. So we got a sort of a one-off benefit in the period. That's used to support growth and also some challenges, as everyone would be aware, within supply chain, where we're seeing more upfront payments required. So we are using that to really manage the growth of the business. The only other thing really to mention in there is, at least from the continuing business, is on capital expenditure. It's been very low in the period. I think that's abnormally low, to be honest. I think that we have a normal annualized expectation of around about 300,000 would be a normalized. I think it will be a little bit lower than that this year, but will be higher than that first year impact that we're seeing there. So will be more of a normalized H2 position. Just at the bottom, again, relating to DCB, is the cash outflow that we've seen in the period. The majority of that is actually relating to some working capital commitments that we had back in April prior to the administration of DCB. The balance of it is the cost to complete, which you'll see is a relatively small amount in total compared to the 4.3 million full liability that we have. We are seeing that ramp up in H2 as those sites come on stream, as I previously described. So we will then sort of start to see that being coming through into H2. And again, aligned to that, we were pretty much at break-even net debt at the half year, so down significantly against the prior interim position and at the full year as well. I think that's probably the best position that we'll be in. As I said, we're starting to now see the DCB payments and costs coming through. So we're really seeing that will have an impact on H2. As you'll see from that, we actually had a reasonably significant cash position at the half year. So we really didn't utilize our overdraft facility at that time, but we will be utilizing that in H2. And we will see and are forecasting that our net debt position will be around about 1.7 million at the full year. Going forward from there, we do have the ongoing DCB commitments, but we are seeing obviously the cash coming through from the continuing businesses. So we are expecting to see a net cash position by the end of the next financial year. So for the year ending 31st of March 2024, we are expecting to be in a net cash position. Just some financing elements around that debt. So we have a number of financial covenants with HSBC, who have the term loan. Those have all been achieved in the period, and we don't expect or see that there will be any significant impact on those, certainly against our forecasts in the forthcoming periods. We have a 1.5 million outstanding finance term loan with HSBC that was due for repayment at the end of September. We've repaid 1 million of that since the full year, and we're due to repay the balance of that at the end of September. But we actually extended that, so we refinanced, but really no new money in that respect. So just extending it for 12 months, so it's repayable in the next financial year. So this time next year, that will be fully repaid and is incorporated into our cash flows, which go forward into expecting that net cash position in the next financial year. We also have a 2.5 million overdraft facility, which I mentioned previously. We've also renewed that, so that's renewed for 12 months under normal terms. So we have the facilities in place to manage the underlying cash flows, including the liabilities relating to DCB, and expect that to be going forward into that net cash position. By this time next year, the HSBC term loan will be repaid. The other term loan that there is a legacy loan related to a former acquisition that will be repaid by there. So we'll just have a balance on the mortgage loan, which would be the only actual borrowing that we have in place at that stage. And my final slide, really just to sort of bring all of that together, just a graphical representation in waterfall, just to demonstrate the movement on that opening and closing net debt with the working capital operational cash flow that's been created from the continuing business. the repayment of the deferred HMRC VAT payments, some small interest and capex payments, and the repayment on the discontinued. So quite simple in profile, to be honest. Very simple in terms of how we're generating and how we're utilising our cash.
Thank you, Clark. Moving on to some of the market drivers within the environment that we're working within. There are two key drivers here, really. One is on the legislation side, and the other is on the government's decarbonisation objectives. Looking at this slide in terms of legislation drivers, one thing that we are seeing coming through now, and it's definitely having an impact in terms of the electrical side, is the Building Safety Act. Following the tragedy of Grenfell, Hackett review was initiated, which led to the Building Safety Bill, which in turn was given royal assent at the end of April this year in terms of the Building Safety Act. Alongside that is the Social Housing Regulation Bill, which is awaiting the third reading in the House of Commons. But the commonality of these two legislation drivers is fundamentally the requirement for landlords to be accountable, and with that, therefore, putting greater power in tenants' hands as a result of this. Very much regulation driven. And certainly with respect to the Building Safety Act, this is very much time bound, because there will be a building safety regulator, which is a new body that's been created in HSE, which will oversee the safety and performance of all buildings, and ensuring that any risks in new or existing high-rise buildings are effectively managed and resolved. So building inspector and building control approval registers will open from April 2024. So this time-bound matter is driving a sense of urgency within the environment, and obviously this accountability, where someone's name will be on that ticket, is in turn driving that necessity to excuse the pun, get the house in order in terms of legislation requirements. Alongside this is the Fire and Safety Act, where the responsible person must ensure that a fire risk assessment is carried out and the necessary action taken to remove or negate any risks that are identified. And flowing on from that is a step up in electrical wiring legislation, where from September 22, so that's in play, arc fault detection devices and surge protection are mandatory for higher risk residential buildings. On the electrical side, the compliance-driven requirements have been somewhat less stringent to date as the mechanical and specifically the gas side. But certainly this theme is changing, and certainly we are seeing across our electrical divisions this impact flowing through into the business. And with that, therefore, we expect this tailwind to continue, certainly over the short and medium term. Moving on to decarbonisation, we're well aware of the government's net zero strategy, and within that is a couple of commitments that they've undertaken. And one is to reduce greenhouse gas emissions from public buildings by 75% by 2037. And alongside that is a clean growth strategy, where the government expects as many fuel poor homes to achieve an EPC band C rating by 2030, and as many as possible homes to achieve that rating by 2035. As of 2019, in terms of a third of all properties were worse than EPC C, so there is plenty of scope there in terms of that driver and objective in terms of the government's commitment. The Department for Business, Energy and Industrial Strategy has estimated that the cost of decarbonising the UK public sector buildings alone to be circa 25-30 billion. And within that, there is a number of other figures that are put on there just to give a feel and flavour in terms of the economic impact that will be required to fulfil this government strategy. Now, to sit alongside that, clearly there will be a requirement for funding within the government's commitment in order to enable this to be achieved. And I'll pass over to Lee Venables, our COO, to share some of those funding opportunities that sit behind this very important tailwind, which I think will continue certainly over the medium to longer term in terms of the opportunity for KINOVO as an organisation.
Good morning, everyone. So David touched on the funding opportunities, and there's 5 key opportunities that you'll see on the slide in front of us. But I think our sector and business is set up perfectly for the 2, which is the public sector decarbonisation scheme and also the social housing decarbonisation fund. And we've positioned ourselves very well in that by going out and getting our accreditations. So we are PAS 2030 accredited. And one of the key drivers coming out of the Business, Energy and Industrial Strategy department is that any business that is able to undertake this work must be PAS 2030 accredited in the work streams that they wish to undertake, which has set us aside from some of our fellow competitors in the market because we've already gone out and got those. To date, we've focused fundamentally on the mechanical ones, which is the air source, the ground source, some of the PV and some of the EV. And we've now turned our attentions to the fabric first approach, which is the insulation, the windows, the glazing, floor, ceiling, wall insulations. And we have our accreditation and assessments booked for early in the new year, and that will then open up the funding. And I'll draw particular attention to the social housing funding, where the local authorities have just submitted their bids. I think it was around about the 18th of November. Local authorities and councils had to get their submissions in. They will find out if they're successful in that funding in early January, February. And we've already seen tenders come out, and there's been a key focus from within not only us, but our bid and business development teams on helping and assisting these local authorities early doors. And that has paid dividends on a number of contracts where we've been told that other suppliers have put in purely based on mechanical elements, and we've gone down the fabric first. And as you'll see, there's in this new wave, £800 million worth of funding being made available for the next 2 years. And that will be match funded by the local authorities. So 1.6 billion over the next 2 years. If you add on to that, some of this public sector decarbonisation works, which we've already done an element of this year for one of the local authorities, where we've done libraries, schools and cricket grounds. So funding is readily available, and we're already in that market. On top of that, you've seen the damp and mould issues. I think there was a recent case up in Manchester, and that just reiterates the strategy of ours to go into the fabric first. You can't put an air source heat pump, a ground source heat pump, because you'll still be losing the heat out the walls and out the windows. So it's vitally important that this damp mould is attacked from this fabric first element. We've also tapped into some of this funded green technologies training, and early in the new year we expect to put not only our apprentices through this technologies training, but also our stream of engineers, which will reiterate that ongoing upskill and development that we're doing with our engineers. So plenty of huge opportunity in the next 2 to 7 years in this decarbonisation and public sector arm.
Lee, if I may also add, just before we move on to the next slide, we're also cognizant that there was a recent announcement of another £1 billion being made available in terms of that insulation piece coming into the new year, and the Chancellor had alluded in the autumn statement of 6 billion of funding becoming available as of next Parliament. Obviously, time will tell, and the devil will be in the detail of whether this is new cash or partly recycled cash. But I think the crux of this is clearly the drive from government and commitment from government to drive decarbonisation, and particularly in the arena that we're currently sitting with regards to the energy crisis that's ongoing. This is ever more relevant and pertinent within the arena that we're currently working within.
I mean, this on the slide now is just an example of some of that public sector decarbonisation fund that we had over the last financial year. You'll see that is right in the heart of our renewables element, and I think that's testament to where we've positioned ourselves, because yes, we've put the air source and the new radiators in, but we needed to go down the fabric first element. So we've done the secondary glazing, the loft insulation, and we've also put some PV panels on. And it's important to add as well that part of this decarbonisation funding is not just stops at the air source heat pump or the insulation, because local authorities, if they want to put the new pipework and the new radiators in, are having to find additional funding to finish these projects. So the opportunities are far greater than what it says on the tin when the funding is put on the table.
Thank you, Lee. If we move then into a slightly more detail with regards to the business split and growth, the left-hand matrix provides a breakdown of the revenue and percentage of total share, both from our three service divisions in terms of mechanical, electrical, and building services, alongside then our three pillars, that is regulation, regeneration, and renewables. On the right-hand side is specifically the revenue increase and percentage growth attributed to each of these service divisions and each of these regulation pillars. As I've covered earlier in the presentation, one, we are well diversified, both in terms of our service divisions and our three pillars, and alongside that, strong growth contributors across the piece within the matrix. I think it's fairly self-explanatory, so I won't dig into further detail in terms of the slide itself, other than to hope that it provides you some deeper flavour in terms of the movers within our matrix of our three pillars and our three service divisions. Moving on to social value, and I'll again leave Lee to cover this. Social value for us is certainly an important driver. We are within an environment where, working within that social housing sector, we have a responsibility within our work to support our partners and our clients within this, to keep our clients obviously safe and warm, but within that as well is to make a difference to society as a whole, and that starts as much internally as it does externally, and we've undertaken a huge amount of work within that sphere to focus the business and drive that culture within and ensure that it reflects externally as well. Lee, maybe you'd like to share some detail on that, please.
I mean, like David said, social value is at the heart of our business, and we've done an awful lot of work with the staff. And this time last year, we run a leadership and development training for the senior managers and directors in the business. Feedback from both participants and the trainer was extremely positive. So now, and as we currently sit, the second round of the leadership and management training is underway, and we've gone down a tier. So we've got supervisors from both the commercial and the operational teams, and also some of the administrators. And what we've tried to identify is the talent pool that we see within the business, and as part of their development and our commitment to these people is to put them through this training. And again, the feedback so far from those participants has been extremely positive, from both the participants and the trainer. But we don't just stop at leadership and management training. In September, David touched on the new electrical regulations that have come out, and we've put all of our engineers back through their 18th edition training, so we've committed to that. We've also done some ad hoc training for the building services team around locksmiths, training, boiler courses. So it's an ongoing commitment from us to continue to develop and train our existing team. I mean, this really started back from when we put in some structured salary banding for our teams. We looked and we could go out and put a man in a van. And if you've been here for a long time, you was maybe overlooked in that salary banding, and we've looked at the skill set, and our engineers are being paid for what they can do. And I think that's actually bearing fruit on us, keeping engineers, attracting greater staff, and upskilling the engineers. And it's almost making us an employer of choice in comparison to others. And some of that is coming through in the personal and professional development that we've seen. If you look at the slide, the photo in the middle is a prime example of professional development within an organisation. Those three in the middle belong to R. Dunham's, one of our subsids. And back in 2019, we went into Dunham's and it was not in a great way. And we was looking at whether we should shut it down, bring it in under one of the other subsidiaries. But the lady in the middle, Alison Beach, joined the business as a 16-year-old accounts clerk, and she's just recently been promoted to commercial director. And she's testament to the change and development within the business that we've put in place. And now that business is exceeding its profits this year. In fact, they've doubled what their forecast was. If you look at the guy on the left, is a guy called Billy Beach. He was an engineer. He's now worked his way up. He was a supervisor, and he's now the contracts manager for Poplar Harker. And Adam Scott, the guy on the right, was an engineer, and he's now supervisor. So a great example of the way you can progress and develop within the group. Of course, the challenges that we face at the moment is labour, and we've now tried to diversify the way we look at that, and we've put a core focus on attending colleges, schools, careers fairs, to try and encourage the younger generation into the construction industry. And Dawn Kemp, our HR director, has in fact gone in and done mock interviews to try and help and prepare the youngsters as they come into their working life. David touched on it. The apprentices are up to 14% now of our business, which is a massive uptick from where we were. And of course, social value is definitely about supporting our communities. And on the right, there's just some examples of where we've gone in to Southwark, and we go in once a week and help out in the kitchens. And there's also some areas on the bottom right where we've taken pieces of land that were disused within estates, and we've transformed them into allotments and garden areas, so that the local residents now can come together and try and forge that sense of community within the local areas.
Thank you, Lee. So in terms of summarising the presentation and where we are, our strategy, business model and investment case remains stronger than ever. Sustainability is at the heart of what we do, and it's underpinned by the predominantly non-discretionary nature of our three key pillars. We'll continue to focus on this strategy and continue to drive through some of the opportunities that we've listed, as well as others that are in play within the organisation. Labour availability remains the key challenge within the operating environment. I think in terms of where we're at, clearly the breadth of our subcontractor base provides us with that flexibility and opportunity to manage that growth while we strengthen our internal resource, which we will continue to do. But labour does remain a challenge across the piece, and I think it's not only within our industry; it's across the globe. It seems in terms of being a challenge from the labour perspective. But we're well positioned. Like I say, we have a strong core in terms of our engineers and operatives, and alongside that, a broad and flexible subcontractor base that we can capitalize on to flex and capitalize on that growth curve. Mentioned earlier, 3-year visible revenues of 146 with 97% recurring. This demonstrates the resilience of the business and provides a solid foundation on which we are to build. Clive alluded earlier in terms of the DCB projects, with 2 being on site already, another 3 scheduled to start at the beginning of the year, and constructive discussions continue with the remaining clients. These projects are now in control, and as Clive also alluded to, at the end of this time next year, we expect to have only 1 of those projects outstanding, upon which we can focus fully on our future. In terms of the employee engagement survey, I have a meeting scheduled with our HR director and social values manager this week to look at some of the key learnings from our employee engagement survey. For those who are not aware, we've undertaken a huge amount within the organization. As Lee mentioned earlier, structured salary banding, so people are rewarded on skills. This improves the efficiency of all of our operatives and engineers. It strengthens our operational gearing by improving the efficiency and productivity of the field force, and the field force themselves start to maximize their potential within the field and the environment that they want to move forward. Alongside that has been other investments within the team, and across the piece, we have also initiated a share incentive plan for all staff, a company incentive scheme that focuses on profitability, so that we are all aligned and driven in terms of driving the profitability of the organization. Softer elements such as increasing the number of holidays, all these contribute to making that package more attractive, not only to reward and recognize the current staff, but to attract new talent into the business as well. Alongside that, like we said, Lee alluded to, was the personal and professional development that we've invested in their staff. We have a responsibility to maximize the potential of all our employees within the business. And there's been a number of opportunities. Whilst Lee highlighted one specific, there's been numerous opportunities within the business where people have been able to progress their career within the group, and we're committed to continue to do that. And within that, by undertaking things like the leadership and management development program, we set a consistency in terms of the culture, the expectations, and with that, the shared values that we have as employees within our business. As I mentioned earlier, we have undertaken a customer insight perception survey that took account of not only our client base. There was a number of verbal as well as verbal interviews, as well as questionnaires that approached our client base, our supply chain, as well as employees as well. There are a number of key themes that have come out of that, and we certainly look to build on strategic initiatives that have come out of that, and to implement those to capitalize on our learnings. So as we move into our traditionally busier half of the year, momentum is continuing. And with that, we are very confident in terms of our full year 2023 numbers to be in line with market expectations of approximately 62 million in revenues and an adjusted EBITDA of 5.3 million. This concludes the presentation, and we'll open the floor to any questions that the audience may have. Thank you very much.
David, Clive, Lee, if I may just jump back in there, and thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. David, Clive, Lee, as you can see, we have received a number of questions during your presentation today. So thank you to everyone on the call for taking the time to submit their questions. And if I could just hand back to you guys to read out those questions, to give responses where it's appropriate to do so, and then I'll pick up from you at the end. Thank you.
Thank you. There is a question here from Nicholas S. in terms of DCB. It states, first of all, thank you for your congratulations with respect to the numbers. The question then is asked that what gives you confidence that your forecast of 4.3 for final DCB payment is accurate? I'll pass this question over to Lee Venables. Lee is heading that DCB project as such, and can provide some deeper flavour with regards to that question.
Yeah, thank you, David. I think Clive briefly touched on details on that 4.3 number previously, and like Clive said, right from the offset, we engaged with a specialist legal and QS firm to undertake a detailed analysis of the 9 projects that we was under the PCG guarantee for. And what ST1 have done is they've visited site, they've taken photos, they've assessed what work was done, what work is left to finish, taken that away and put that all into a large cost to complete detailed analysis of a project by project basis. And then they've tested that against market rates, inputted those costs and expected outturn of costs into this Excel document. They've built in some inflationary increases into them costs, and we are very comfortable and confident that that number then gets us back to this 4.3 number that we've stated all along. So very confident, very comfortable that the analysis, the forward looking with an inflationary increase has been put into play, and on a project by project basis that's been analysed and put back into the master document.
And with that, Lee, just to reiterate your point there, a number of the packages that are being let with the current projects that are on site are reaffirming that by either coming in line or below the expectation.
Yeah, good point.
Thank you. There is a question here from Cyril Lee, which asks, the full year forecast implies significantly slower growth for the HY second half compared to the first half. What causes the slowdown? Clive?
Yeah, I'm not sure it's significantly slow, to be honest. I think we're 31% up at half year, certainly at an EBITDA level. And I'll focus on the EBITDA level for simplicity. We have a forecast, full year forecast of 5.3 against 4.2 in the prior year. So that's up around about 26%, sorry, overall for the full year. So a slight slowing in the second half. And I think that what we have is, David stated earlier, we have Q4 is our biggest quarter, and therefore is the most uncertain. It's a period in which there are budgets that are being utilised and projects that are late in the financial year that are coming through. So what we've done is very much forecast what we can see and what we're aware of. So there is an opportunity for further revenues to come through, but also within those run rates, which we build in some element of uplift as to an element of uncertainty is what's coming through. So we've really taken a very much a sort of a middle ground in terms of expectations.
Thank you, Clive. There is another question here from Michael W. in terms of what impact is cost inflation having on your core business profit margin? Well, we could all answer that, but perhaps Clive, if you want to.
Yeah, I mean, obviously it is having an impact. I mean, certainly what we are seeing is staff cost inflation is there undoubtedly, and David alluded to some of the elements that we're doing in terms of staff retention and staff hiring and costs relating to that. So there is an impact within that and on other elements of the business. What we do have within our contracts, there are mechanisms within our contracts to be able to recover some of those cost uplifts on an annualized basis. So we do have an ability to be able to look at the prices and to return on the prices to effectively to mitigate that impact. And then we're really sort of undertaking a number of efficiency and effectiveness and utilization projects to ensure that we are continually working more efficiently within the business.
Clive, I think alongside that we should add with respect to the efficiency. Obviously, with the we rolled out an incentive scheme last year, which, as I alluded to earlier, is focused entirely on profitability. This has certainly refined the focus at all levels within the business to ensure those profitability targets are focused on in terms of any efficiencies, whether it is going back promptly to the clients and/or just ensuring that wherever feasible, we drive that focus throughout the business. Alongside what Clive alluded to in terms of the ability to go back to clients on some of these matters, these are part and parcel of our contractual processes. Over and above that, of course, and I come back to the three pillars where regulation, through the regulation process and the work that we undertake, which is fundamentally within our contracts, will be required to have remedial work undertaken. Now, this remedial work, alongside additional project streams that come within that contract under the planned works, are all priced as those requests come in. So therefore, they take into account current market rates, whether it's subcontractors, materials, etc., as well, which does provide that additional level of protection for us as we are pricing it in accordance with where we sit currently in terms of the market dynamics. Another question here from Cyril E. In the annual report in note 23, trade and other payables, it can be seen that accruals increased from 0.9 million to 3 million. What's led to the increase, Clive?
Quite a detailed question there, I guess. I haven't got every single reconciling item to that. I think that the major drivers on that will be DCB related. So we did have a quite significant accrual on the legacy DCB liabilities. I alluded to them earlier in terms of the cash flow on the working capital payments that we were required to make on DCB relating to back in April. So that was accrued for in the last year's annual accounts. The 4.3 million of the cost to complete, that wasn't, because that was a post-balance sheet event. But that was a pre-balance sheet liability, at least, but paid in April. So that's a big uplift. And again, I think the other significant element within that would be, and again, David has been into some detail on that in terms of incentivization within the group, in terms of driving bottom line profits, so profitability focus. So within that accruals number as well will be the accrual for bonus relating to that performance. And that was on the back of the year-end number 4.2 million being almost double, I think actually over double the previous year's profit. So in the previous year there wouldn't have been virtually no accrual, I think, on bonuses. So I think that's probably at least part of that balance in terms of that uplift.
There is a question here from Paul T in terms of how much of the revenue growth is postponed revenue from withheld work during COVID. Again, I think Lee and I could well, and Clive answer that question. There's certainly a contributor in that regard, because clearly access issues was the dominant challenge for all of us in terms of the work during COVID, as well as a sort of general shutdown externally. Obviously, with our regulatory work, there was a lot of compliance necessities which we had to undertake as and when was safe to do so, with both the tenants and our engineers and operatives front of mind in terms of keeping them safe. So there is unquestionably a contributor in terms of that backlog, in terms of postponed revenue. However, I think actually the bigger driver from that growth is stemming from what I alluded to in terms of these legislation drivers, and in part that decarbonisation commitment from the government as well. And in balance, that is far more of the tailwind that we have in revenue growth this year and expect to see moving forward, rather than the backlog from COVID itself per se. Lee, is there anything else you add?
I think mainly any of that tailwind was probably more on our regeneration pillar, because during COVID we was still undertaking, certainly from a mechanical perspective, the gas safety checks, because that was still law. So if there is any tailwind, it is some of these planned projects that were paused during that period, and we're certainly starting to see that come through. But the tailwind is not certainly the tailwind from a regulation perspective from the electrical side, because that's touching back on the Building Safety Act that David spoke about earlier, and that's seen a big tick up in what we've got coming through.
There is a question here from Joe M in terms of what were the legacy customer relationship balances. Was this DCB or something else?
Yeah, it was DCB and it was something else as well. So it relates around each of the acquisitions of the businesses. So actually for each of the businesses there was, as I said, it's fully amortized at the end of September. So there are no balances left on that, but they're originally related to effectively the intangible asset that was calculated at the time of acquisition on each of the businesses, in fact. So each of those have been amortized over different periods of times relating to the assessment at the time of the acquisition.
Thank you, Clive. There's a question from Sam E. How is the search for a new chairman going, and when do you expect this to be finalised? The search is in play as we speak. The responsibility of this sits with the non-execs at this stage. We are looking to finalise the engagement of an external search consultant, and with that, then we expect in the new year to start to progress that in terms of that process. I think coming into, and certainly this has been the feedback from what I've heard in terms of the search consultants, there does tend to be a dip as you move into Christmas, and coming into the new year is when literally everything sort of comes back to life, should we say. So that it is in process. We will have, as we said, consultants in play to facilitate that recruitment process. The responsibility fundamentally sits with the non-execs in terms of driving that process, and therefore in terms of expecting it to be finalised, clearly we will finalise it as soon as we can find the appropriate person to take the organisation on and take this forward as a chairperson. But certainly I expect this pace to pick up in the new year. Paul T has asked the question, how do you intend to use excess cash in the future? Any idea to return it to shareholders via buyback, dividends, or reinvest it into smaller acquisitions? I think clearly from our perspective, the focus for us is to drive this organic growth of the business, to see the back of the DCB scenario once and for all, and with that then obviously as we continue that growth curve, be in a better position to evaluate all of those options, whether they be buyback, dividends, or smaller acquisitions as well. I think in terms, obviously, current shareholders will be aware that we intended to reinstate a dividend policy, and therefore, that is something we'll look to revisit as soon as possible in terms of that cash process. Regards to acquisitions, certainly we're within a very fragmented market, so the potential for acquisitions is undoubtedly there. If we were to look at acquisitions, certainly we would want to be focusing on broadening and deepening that regulatory-driven, compliance-led type portfolio. I think there are opportunities here to build depth within our three service divisions in terms of mechanical, electrical, and building services, and with that, that compliance focus, non-discretionary focus, and fundamentally in terms of certification, that allows us to provide more complete solutions in terms of our direct ownership rather than potentially through part of our subcontractor chain, would be part of the evaluation process within their smaller acquisitions. But at this stage, like I said, the number one thing for us is to drive that growth and to get back into that cash positive position, because we will have all these options in our hands as a result. Joe M, cash conversion driven by HSB purchasing card. Without the cards, what would the conversion rate be? How do you show these cards on your net debt? Clive?
Yeah. Our cash conversion from one of my earlier slides was 130% in the period. As I stated, that was certainly uplifted by the utilization of the purchasing card, which is great for us to be able to operationally control our business, manage the growth, and manage supply chain challenges, if I can say it, within the business. We actually think that probably without it in the period, it would have probably been in the 90s, 90% cash conversions. So around about our target expectations that we would have expected. So that's kind of what we would have expected to have achieved. We actually disclose it within our trade payables notes. So and there's appropriate disclosures within that note as on the basis that we use it as an operational facility.
There is a question here from Cyril E. Are there any news regarding legal actions taken by MCG Global against the company? We have got news with that regard. MCG Global have dropped all legal actions or proposed legal actions against the organisation. So we have confirmation that they will not be pursuing anything any further, and therefore we regard that perspective as closed. There is another question here from Michael W. Is there a seasonal bias in revenue? By the nature of our work, there is indeed. Effectively, the local councils and local authorities' financial year coincides with ourselves. So if we take quarter one, first of all, which is April the 1st onwards, that tends to be the slowest quarter, should I say, for us, due to councils sort of reaffirming, realigning, and confirming their own budgets internally before they start issuing work. So Q1 tends to be historically the quietest year, and then it picks up progressively as we go into the other quarters. Certainly, obviously, quarter three and quarter four are our busiest quarters. Quarter four, because that is the end of the financial year, and with regards to budgets and spending, our financial year is aligned with the local councils, where they want to ensure that the budget is sufficiently allocated in terms of their assets. Therefore, quarter four is the busiest. And with that, quarter three, obviously, as we're moving into winter as well, the requirements on the mechanical team starts to pick up in Q3 and Q4. Obviously, with the legislation changes, that may tweak that movement across the quarters, but as a trend, it starts with quarter one being the slowest, should we say, with a pickup moving across the quarters towards the year end. There is a question here from Paul T. Any reason why we don't see any insider buying at this level? In terms of that, there has been one or two reasons, and in part, obviously, we just mentioned that the MCG Global scenario, part and parcel of various reasons why, as a board, we've not been able to purchase during timeframes. But outside of that, there have been a purchase by one of the execs in not so recent timeframes. But there has been reasons for that in terms of restrictions on purchasing. Philip M, is there likely to be any revenue from the continued work on DCB contracts? Clive?
So yeah, there is. I mean, but it's actually accounted for within the net cost to complete. So when we spoke about the cost to complete, the 4.3 million, that's actually a net position between revenues and costs. We disclosed that at the year end as well in the post balance sheet event note. So effectively, there is a process that each of those projects goes through in a periodic valuation process. So we're doing the works, we value it, get payment from clients, and then paying it out. So there is a process. But it's within that 4.3 million cost to complete.
There is a question here from John H. Can you provide some detail on the bid tender team? How many bids would normally be submitted in, say, a 3-month period? And what would be the typical value or range, i.e. 100K to 20 million? Also, what would be the typical length time period for the contracts? 1 to 10 years? Lee?
Yeah. So if I break down the question into bullets for that. So we've done a lot of work on the bid team over the last couple of years. I mean, if I go back to 2019, we had 1 bid writer in the team, pretty much doing everything. Since then, that's now been increased to 3 in the bid team. We've got a bid manager. We've also got a full-time estimator in there, and we've also got an assistant bid manager. And coupled with that, to bolster the team when the peaks and troughs come in, we've also engaged with some external resource to also assist and aid in that. If I look at typically how many bids would be submitted in a 3-month period, if I go back over the last quarter, it's around about 5 a month that have been submitted. So I know in the last 3-month period, we've put in 15 bids, which would then lead on to the value range, and they are typically anything from a one-off project that could range from 150K to 200K, or up to the biggest one that we've got sat in the bid at the moment, which is 20 million per annum. And these will typically be, like I say, anything from a one-off project to contracts that span 3, 5, 7, 10-year terms. And typically, if I look across our portfolio, we are pretty good at retaining contracts. We've got an average relationship across the period of about 9 years plus on any of our contracts. Current outstanding bids, just to add a little bit more flavour to the question, is about 19. And they've got an outstanding value that's attributed to those 19 bids of about 341 million. And typically, in regards to any of the bids that we do on a quarterly basis, our hit rate is about 1 in 3.
Thank you, Lee. There's a couple more questions here. One is to Joe M. What is the 1 million move in inventories in the cash flow relating to, Clive?
Yeah. So inventories in the balance sheet are made up of 2 component elements. There's a kind of raw materials and stock, and the other component, which is the more significant element of that, is work in progress. So the movement will principally be driven by increase in that work in progress, which is effectively representative of that growth that we're seeing within the business. So we're seeing that the work in progress is driven from that. We are sort of proactively trying to manage and keep to a minimum the value of the raw materials and stock.
Thank you, Clive. I think that essentially covers the questions from what I can see. in terms of where we are at. If there are no other questions that are coming through, then perhaps we can pass back to Jake.
David, absolutely. Clive, Lee as well, thank you very much indeed for addressing all of those questions that came in from investors this morning. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended for you to review, to then add any additional responses, of course, where it's appropriate to do so. David, perhaps before redirecting those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
Thank you, Jake. First and foremost, I'd like to thank everyone who has attended this presentation, and thank you for your interest in KINOVO and our progress. With results to the organisation, as I've said earlier, I think our strategy, business model, and investment case remains stronger than ever. Whilst clearly we recognise that our turnaround process and our restructuring, repositioning process has not been without challenge, and I make particular reference to DCB. Overall, in terms of where we're at and where we are going, I think there are a number of tailwinds that sit behind us from a legislation perspective, as well as obviously that government decarbonisation commitment with respect to our three service divisions of mechanical, electrical, building services, and our three key strategic pillars in terms of regulation, regeneration, and renewables. I think we're in well positioned in terms of capturing these tailwinds. As we said, you know, the underlying growth is strong. We've got that visible revenue visibility in terms of our outlook. We are throwing off reasonable amounts of cash, and as an organisation, we are focused to capture the growth opportunities that lie ahead of us. So, if I'm not in touch with any of you directly beforehand, on behalf of the team, I'd like to wish you all obviously a safe and enjoyable festive season, and no doubt we'll look forward to catching up with you at the next presentation, if not before. Thank you very much indeed.
David, that's great. And Clive and Lee as well, thank you very much indeed for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This won't take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of KINOVO PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.